Something just happened inside the COMEX silver vaults that the major banks are desperately trying to keep quiet. And if you own even a single ounce of silver, what I'm about to tell you could be the most important financial information you hear this year. Here's what actually happened. Over the past 72 hours, registered silver inventory at the COMEX, that's the silver that's actually available for physical delivery, dropped by 8.2 million ounces. Not traded, not transferred between accounts, physically removed from the vaults, loaded onto armored trucks, driven out of secured COMEX facilities in New York and Delaware, and delivered to private buyers whose identities remain completely hidden from public records. Let that sink in. 8.2 million ounces of physical silver vanished from COMEX registered inventory in 3 days. That's over $250 million worth of metal at current spot prices. Gone, removed, taken off the board permanently, and not a single mainstream financial outlet has reported on it. COMEX warehouse data published yesterday afternoon confirmed the drawdown. Registered silver inventory fell to its lowest level since 2016. Total registered ounces now stand at just 28.4 million ounces across all approved depositories. That sounds like a lot until you realize that open interest on COMEX silver futures currently represents paper claims on over 800 million ounces of silver. Translation: for every single physical ounce of silver sitting in COMEX vaults, there are roughly 28 paper claims against it. 28 people think they own the same ounce of silver. Only one of them actually does. And right now, somebody is pulling those real ounces out of the vault before the other 27 figure out what's happening. This is not normal market activity. This is a vault raid. And the banks that manage COMEX silver inventories are panicking behind closed doors. Let me explain why this changes everything. The COMEX is the world's primary silver futures exchange. It operates under the CME group and serves as the price discovery mechanism for global silver markets. When miners sell silver, when manufacturers buy silver, when jewelers source silver, the price they reference comes from COMEX futures contracts. But here's the dirty secret that Wall Street doesn't want retail investors to understand. The COMEX doesn't actually need to have enough physical silver to back all those futures contracts. The system operates on the assumption that the vast majority of contracts will be settled in cash, not physical delivery. Only a tiny fraction of traders ever demand actual metal. That assumption is the foundation of the entire silver pricing system. And it's cracking. Because someone with very deep pockets just demanded physical delivery on a scale that the COMEX hasn't seen in nearly a decade. They didn't want a cash settlement. They didn't want paper promises. They wanted real metal, and they took it. COMEX officials released a brief statement calling the inventory movement routine vault adjustments, reflecting normal commercial activity. But here's what COMEX officials didn't say. They didn't identify who withdrew the silver. They didn't explain why registered inventory hit a 9-year low. They didn't address why the drawdown accelerated dramatically over just 72 hours when previous months showed gradual stable movements. They didn't acknowledge that the ratio of paper claims to physical silver has now reached levels that would be considered catastrophically over-leveraged in any other financial market on Earth. Either COMEX officials genuinely believe that a 28-to-1 paper-to-physical ratio represents normal, healthy market conditions, which means they're delusional, or they know the situation is dangerous, but they're choosing not to warn market participants, which means they're complicit. Both scenarios should terrify every silver investor watching this right now, and it gets worse. 3 days before the vault drawdown began, JP Chase, the largest holder of silver derivatives in the world, quietly adjusted its silver short position. According to the latest bank participation report from the CFTC, JP reduced its net short silver position by 4,200 contracts. That represents approximately 21 million ounces of paper silver exposure that JP no longer wants on its books. Think about what that means. The biggest bank in the silver market is reducing its bet against silver prices at the exact same moment that physical silver is being pulled out of COMEX vaults at the fastest rate in 9 years. JP isn't stupid. They have more information about silver market flows than any entity on the planet. They can see who's buying. They can see who's selling. They can see vault movements before they're published. And right now, JP is backing away from the short side of the silver market. When the biggest shark in the ocean starts swimming in the opposite direction, you don't ask questions. You follow. But the retail silver market hasn't gotten the message yet. Spot silver is trading at approximately $31 per ounce. Premiums at major online dealers have actually decreased over the past month. Silver sentiment among retail investors is lukewarm at best. Most people aren't paying attention. That disconnect between what's happening inside the vaults and what retail investors believe is happening represents one of the greatest asymmetric investment opportunities in modern financial history. Ted Butler, the most respected independent silver analyst in the world, published an urgent note to subscribers this week. He wrote, "The commercial short position in silver has been reduced to levels not seen since 2019, just before silver ran from $18 to $30. The vault drawdowns are confirmation that large physical buyers are positioning ahead of a move that the paper market hasn't priced in yet. Veteran precious metals analyst David Morgan echoed the warning. The registered category is being drained systematically, he said. This isn't random. Someone knows something and they're acquiring metal before availability becomes a serious issue. Even Jeffrey Christian of the CPM Group, who has historically been bearish on silver and dismissive of supply squeeze narratives, acknowledged in a recent webinar that current COMEX inventory levels warrant close monitoring. The drawdown rate is unusual, he said. It could be a one-time event, or it could signal a longer-term trend of physical offtake exceeding replenishment. 3 analysts, 3 different perspectives, all watching the same vault data, all reaching the same conclusion. Physical silver is leaving the COMEX at an alarming rate. And nobody in the mainstream financial media is covering it. So why aren't the banks talking about this publicly? Because the entire silver pricing system depends on confidence. Confidence that COMEX has enough silver. Confidence that futures contracts can be settled. Confidence that the paper price reflects real supply and demand fundamentals. The moment that confidence breaks, everything changes. If large futures holders start demanding physical delivery instead of cash settlement, COMEX doesn't have enough silver to honor those contracts. Not even close. At current inventory levels, if just 5% of outstanding contracts demanded delivery, COMEX would default. Not might default, would default. Mathematically, inevitably, completely. And here's where Trump's tariff policies accidentally poured gasoline on an already smoldering fire. The 25% tariffs on imported metals have disrupted global silver supply chains. Silver that normally flows from Mexican and Canadian refineries into COMEX approved depositories is now subject to additional costs and delays. Refiners are rerouting shipments to avoid tariff exposure. Some are holding inventory rather than shipping into an uncertain trade environment. The result is that COMEX vault replenishment has slowed at the exact moment that withdrawals have accelerated. Inflows are down, outflows are up. The gap is widening every week. Trump's trade war didn't create the silver supply crisis, but it just made it significantly worse. Meanwhile, industrial demand for silver is hitting record levels that nobody predicted 5 years ago. Solar panel manufacturing consumed over 200 million ounces of silver in 2024. That's nearly 25% of total global mine supply going to a single industry. Electric vehicle production requires silver for battery connections, charging systems, and electronic controls. 5G infrastructure deployment needs silver for high-frequency connectors and circuit boards. Artificial intelligence data centers require silver for thermal management and electrical conductivity in high-performance computing systems. Every major technological trend of the next decade requires more silver, not less. More, and mine supply isn't keeping up. Global silver mine production has been essentially flat for 6 years. Major silver deposits are declining in grade. New discoveries are rare and take a decade or more to develop into producing mines. Recycling rates have plateaued. The supply deficit in 2024 was estimated at 176 million ounces. That means the world consumed 176 million more ounces of silver than it produced. Where did those extra ounces come from? Existing inventories, vault stockpiles, the same reserves that are now being drained from the COMEX at accelerating rates. This is what a slow-motion supply crisis looks like before the market recognizes it. Gold has already responded to similar dynamics. Gold prices have surged past $3,400 per ounce this year, driven by central bank buying and geopolitical uncertainty. The gold-to-silver ratio currently sits above 100 to 1. Historically, that ratio averages around 60 to 1. At the peak of the 2011 precious metals bull market, it reached 32 to 1. If silver simply reverted to its historical average ratio with gold at current gold prices, silver would be trading at $56 per ounce. If it reached the 2011 ratio, silver would be at $106. Either scenario represents a massive move from current prices. And the vault drawdowns suggest that someone with deep pockets and serious intelligence is positioning for exactly that move right now. The banks know what's coming. That's why JP Morgan is covering short positions. That's why COMEX registered inventory is being drained. That's why no mainstream financial outlet is covering this story. The last thing the banks want is a rush of physical demand that accelerates the timeline of a supply crisis they already can't control. Every ounce that leaves the vault makes the remaining position more fragile. Every contract that demands physical delivery instead of cash settlement moves the system closer to breaking point. Every day that mine supply fails to keep pace with industrial and investment demand pushes the deficit wider. Today, COMEX has 28.4 million registered ounces. Tomorrow that number could drop below 25 million. Next week it could hit 20 million. And at some point, a number that was already dangerously low becomes a number that triggers forced settlement, delivery failures, and a price reset that the paper market never saw coming. That's not speculation. That's arithmetic. The vault raid that happened this week wasn't just a large withdrawal. It was a signal. Someone is taking physical silver off the market because they know that the price printed on futures screens does not reflect the true scarcity of the metal underneath. That's not a market functioning normally. That's a market being front-run by insiders who understand what the COMEX inventory numbers actually mean. And the most alarming part is this. The 8.2 million ounces that left this week might just be the beginning. If this buyer continues at the same pace, COMEX registered inventory hits zero within 14 weeks. Not months, not years, 14 weeks. That's not a market correction. That's a systemic event. And it's happening right now while silver trades at $31 an ounce and the financial media talks about interest rates and tech stocks and everything except the vault that's being emptied in broad daylight. The question isn't whether the silver market is heading for a crisis. The question is whether you'll position yourself before the banks finish positioning themselves. Based on what just happened inside those vaults, the answer to that question has never been more urgent.